Deferred revenue. First of all, we have to discuss meaning of deferred revenue. Deferred revenue is a liability account that represents revenue received by a company in advance of the goods or services being delivered. What do you understand, friends? So deferred revenue is a liability. So revenue received by a company in advance. So this is the revenue received by a company in advance. For example, first of all, we discuss example for better understanding. A software company signs a contract with a customer for a 2-year license for $24,000. So one software company signed an agreement for rendering of services $24,000 for 2 years. That means per year $12,000. The customer pays the entire amount upfront. So immediately our company receives $24,000, but the service is not rendered yet. So it's a liability because we received amount but we not rendered services yet. I hope you understand. The customer pays the entire amount upfront. In this case, the software company would record the payment as deferred revenue on its balance sheet since the revenue is not yet earned. So, okay, $24,000 received, services not rendered yet. So that's why we record as liability. Why we need to record deferred revenue? Because it's a more than 1 year. So that's why it's a deferred revenue. Okay. Now we go for meaning for better understanding. So deferred revenue is a liability account that represents revenue received by a company in advance of the goods or services being delivered. The revenue is recognized as earned revenue only when the company delivers the goods or services to the customers. So when we will recognize as revenue when we provide services to the customer. So here $24,000 for 2 years. If we render 1 year services, then we recognize as revenue 12,000. Okay. Next continuation. Amortization of deferred revenue is the process of recognizing a portion of the deferred revenue as earned revenue over the period of the contract or service agreement. So amortization. So what is amortization? So already we recognize deferred revenue. So if we render services, then we amortize the amount, how much services we rendered. Okay. Now we go for entries. When the company recognizes the revenue over the 2 years of the contract, it would make the following entries. First entry, to record the initial receipt of the payment. So first we receive amount. So what is the entry? Cash account debit, credit side deferred revenue account. Okay. So cash account is a real account. So cash account debit to deferred revenue account. Okay. Deferred revenue is a liability. So all liabilities are credit. How much amount? $24,000. So $24,000. Next, second entry, to record the amortization of deferred revenue in the first year. So in the first year, that means after rendering services for 1 year, we have to amortize that amount. How much amount? $12,000. Okay. What is the entry? Debit deferred revenue account, because at the time of receipt of amount we credited deferred revenue account. So now we have to amortize that amount. That's why we have to debit deferred revenue account $12,000, credit revenue account $12,000. So revenues are created. So it's a basic principle, golden rules of accounting. So deferred revenue account debit $12,000. Now we have to recognize revenue $12,000 because already rendered services for $12,000. Okay. Next, third entry, to record the amortization of deferred revenue in the second year. So, second year also same entry. So, what is the entry? Deferred revenue account $12,000, credit to revenue $12,000. Okay. So, the above entries would result in the recognition of $12,000 of revenue in each of the 2 years, which is the amount of earned revenue under the contract for that year. I hope you understand. It is simple one. Amortization of deferred revenue schedule. What is the amortization of deferred revenue schedule? An amortization schedule for deferred revenue is a table that shows the amount of deferred revenue recognized as earned revenue in each period of the contract. It typically includes the following columns. So, in a company, they follow one format, okay, in Excel or any software they maintained. So, in that generally for the columns are for deferred revenue period. So, what is the period? This column shows the period number, example month, quarter, year of the contract. Next column, beginning of deferred revenue balance. So, this column shows the balance of deferred revenue that beginning of the period. What is the beginning of the period deferred revenue? $24,000. Next, amortization amount. Amortization amount. This column shows the amount of deferred revenue that is recognized as revenue in the period. Okay, amortization amount. That means first year $12,000, second year $12,000. Next, ending deferred revenue balance. This column shows the balance of deferred revenue at the end of the period, which is equal to the beginning balance minus the amortization amount. So, that means in our example, at the first year end, we have balance of $12,000 for next year. Next, the amortization schedule for the software company in the above example would like this. So, actually it's a note. I don't prepare table for this. Okay, I hope you understand overall concept. I said simple understanding. Thank you. Subscribe and okay. Thank you, friends.